All right, let's talk about a question that pretty much every new trader has on their mind. How in the world do you grow a small account without just blowing it up on some crazy high-risk bet? We're going to get right into a disciplined way to do just that.
You know, this is the dream that pulls so many of us in, right? This idea that with just a few clicks, you can turn a couple $100 into a small fortune. It's this intoxicating idea, and it's fueled by all these stories you see online. But is that really how it works?
And this quote, man, it just hits the nail on the head. So many people approach trading like it's a lottery ticket. They're chasing that one big jackpot. But if you talk to any trader who's been doing this for a while, they'll tell you that real, sustainable success looks nothing like that. And honestly, believing it's a lottery is the biggest hurdle to get over.
And you know that whole lottery mindset? It leads you right into what you could call the small account trap. You start chasing those massive, life-changing gains, and that makes you think you have to take on huge risks to get there. You start telling yourself that these small, careful, defined risk trades are just a waste of time. And before you know it, you've made a few bad calls, and your account is gone. It's a really vicious cycle.
Okay, so how do you break out of that trap? Well, it all starts with a huge shift in your mindset. You have to completely stop chasing profits and instead become obsessed with managing your risk. Seriously, this is the foundation for everything else we're about to talk about. Let's just go ahead and dismantle the biggest myth in trading. The story we're all told is that you have to risk big to win big. High risk, high reward. But the reality? The thing that professional traders really get? It's that true, lasting wealth is built by compounding small, consistent, low-risk wins over and over again over time.
So here's the key takeaway. You have to learn to respect the risk you're taking way more than the reward you're hoping for. Think about it. When you're a new trader, it's usually greed that makes you hit that buy button. But the second you're in that trade, what happens? That greed instantly flips to fear. The way you beat that is by focusing on your risk before you ever get in. That's how you control the emotion and actually stay in the game.
So what does respecting your risk actually look like? It's a number. And for a new trader, that number should be 2%. You should never, ever risk more than 2% of your account on one single trade. It sounds tiny, I know, but that one rule is what separates the gamblers from the people who are actually building wealth.
Now, once you get your risk locked down, the math behind actually being profitable gets surprisingly simple. And honestly, it's kind of liberating. It's like a puzzle, but it's one that's way easier to solve than you think.
So here's the big secret, the thing that most people just don't get. You don't need to be right all the time. You don't. You don't need some crystal ball or a 90% win rate to build an account. The most powerful tool you have on your side isn't being right, it's time. Now check this out. This is where it gets really cool. If you're winning 75% of the time, your wins can be just a third of the size of your losses and you'll still make money. But here's the crazy part. Look all the way down at the bottom. Even if you are only right 25% of the time, you can still be profitable. How is that possible? Well, it's by making sure your winning trades are at least 3 times bigger than your losing ones.
Just let that sink in for a second. 25%. That means you can place 4 trades, lose 3 of them, win on just 1, and still come out ahead. This idea completely changes the entire game.
So how does that work? It's all about that 3-to-1 reward to risk ratio. Let's say you risk $10 on each of those 4 trades. The 3 you lose cost you $30. But that one winner, it makes you $30. You break even. If it makes you anything more than that, you're profitable, even though you were wrong 75% of the time. That is the mathematical edge that pros live by.
And that right there, that's the whole point. Success in this game isn't about being some perfect fortune teller. It's about having a mathematical edge and the discipline to just let that edge play out over and over again. You can be wrong way more than you're right and still grow your account.
Okay, so that's the theory. But how do we turn this math into something we can actually use? Let's build a simple, repeatable blueprint. Let's build a compounding engine that's designed for steady, predictable growth. So forget about trying to double your account in a week. Our new target is something way more realistic and way more powerful. The goal is 6% account growth per month. I know it doesn't sound sexy, but stick with me here because this is where the real magic happens. So how do you hit that 6%? It's actually pretty simple. You just aim for a small, consistent gain, like 20 pips a week, which is just a tiny measure of price movement.
You risk a very small 1.5% on each trade, and you only need to find setups where your potential reward is about the same as your risk. A simple one-to-one setup. One trade a week can get this done. And then you just sit back and let compounding do all the heavy lifting for you.
Let's make this super real. Say you have a $1,000 account. Risking 1.5% means you're only putting $15 at risk on any single trade. $15! If you lose, are you going to yell at your dog? Probably not. It's a totally manageable loss that keeps you psychologically sane and ready for the next trade. So, what happens if you actually stick to this quote-unquote boring 6% a month plan? Well, you start with $1,000. After 1 year, it's over $2,000. Not bad, right? But what if you don't add another dime and you just let that sucker compound for 10 years? That $1,000 grows to over $1 million. That is the insane power of patience over gambling.
All right, so theory is one thing, but how do you actually find these kinds of trades? Obviously, we can't do a full trading course right now, but just to show you this is a real practical process, let's look at one quick example of a strategy that fits this risk-first model perfectly. This particular strategy is built around a concept called an order block. So what is that? All it is really is a spot on a daily chart where the big institutions, the banks, the hedge funds, made a huge move. The whole idea is that these zones give you really clear, logical places to define your risk, which is exactly what our whole model is about.
So the process breaks down into 3 simple stages. First, you find that institutional footprint, the order block, on a nice high time frame. That gives you a solid area to plan a trade. Second, you just patiently wait for the price to come back to that zone and give you a clear signal to get in. And third, you manage the trade by taking little bits of profit at logical targets, locking in your gains, and letting your mathematical edge do its thing.
And this really brings us right back to the core idea. This entire approach, this whole philosophy, is designed to do one thing: double your money every year. Not every day, not every week. It's a low-hanging fruit. It's a manageable goal that helps you build skill, discipline, and eventually some serious wealth. So, that leaves us with one final question. 10 years from now, where do you want to be? Because you really do have a choice. You can keep chasing the financial lottery ticket, always hoping for that one lucky break that's probably never going to come. Or you can embrace the slow, steady, and proven power of patience and compounding. The choice is yours.